had a moment or two when you thought, how do I know if I'm on the right track? Is my business doing okay? Like when you were paying bills and noticed that things were getting a little tight in your business's account. If, right, you regularly or you do a regular pulse check of your business's financial health, you won't have to vaguely stress about how things are going. You'll just know. So in this video, I'm going to ask you 7 questions that will help you assess your company's financial health so that you can build a business that everyone and their rich uncles wants to buy or invest in. So first question, how are your profits? Booming sales don't actually tell you much. You need to look at profit. You can find out how much money your business brings in after bills by subtracting your operating costs, right, from your total revenue. But skimming through your financial statements and just looking at your profit isn't a good way to assess the financial health of a company. It only gives you one small piece of a much larger pie. Second question, how much are you spending on inventory? So you've got to spend money to make money. We know this. By looking at your cost of goods sold, COGS for short, you can see just how much money you need to spend to keep your money-making machine, also known as your company, going strong. So COGS is the cost your business spent acquiring or producing items that you've already sold to your customers. By itself, it may not seem like a big deal, but when combined with other business metrics in your financial audit, COGS can help you do a few things. 1, find your ideal pricing structure. 2, help you gain a bigger picture of your company's overall financial performance. And 3, it can also help you assess, the profitability of your different products. So how do you actually calculate COGS? So COGS is your beginning inventory plus inventory purchases made during the year minus ending inventory. From this, you can use this number to calculate your gross margin, which will show you how your business is doing in the profitability category. Third question, how much are you making on products sold? So let's say you want to know how much you're making on each sale, right? Then you just need to take a look at your income statement and calculate your gross margin. So your gross margin, right, shows the amount of revenue that you brought in before factoring in business expenses that are unrelated to your COGS. Now, how do you calculate your gross margin? So gross margin equals, right, and mind you, it's a percentage, right? So it's revenue minus COGS divided by revenue times 100 to make it a percent. And this tells you how much money your company is keeping as gross profits after the cost of goods sold. So let's say your gross margin is 15%. That means you're only making 15 kobo for every naira of revenue that you bring in. If you want to get an idea then of how much you make without the percentage, then just factor the gross profit without the margin. And what is gross profit? It's your revenue minus your cost of goods sold, COGS. So when you're performing a small business audit, you can calculate gross margin to help you do a few things again. 1, assess your company's efficiency. 2, predict the money you have from sales to cover additional overheads. And then 3, make better pricing decisions. So a decreasing gross margin, right, would be an indicator that your business may be on the decline, and means that you might want to recoup some of your losses by maybe cutting down your labor expenses or spending less on materials.